how many scenarios you need for a VAR calculation, you know, what are the key factors that go into your potential exposure calculations. And it's totally different now as a CRO, sir. I wonder, like, you've got external factors, you've got internal factors, you know, which of those are more concerning to you, or are they both concerning, and in which cases, you know, are you more worried?
Yeah. Let's first put the question into perspective. So the World Economic Forum survey for chief risk officers has as main risks four. One, macroeconomic landscape. Second, supply chain disruption. Third one, geopolitics. And fourth one, new regulations and compliance. On the other side, the Bank of America Fund Manager Survey as well has four main risks. One is inflation rates. Second one is geopolitics. Third one, banks crunch or economic recession. And the fourth one is which is going to be the major credit event, such as China real estate or zombie companies in the US, right? So as a managing director of risk, I'm really concerned on rates higher for longer, right? So the implication, for example, on delinquencies, implication on scarce liquidity, for example, the implication on deposit betas, so the cost of deposits, for example, the implication on our balance sheet for this rates volatility. So I'm going to diverge a bit with Suresh. It is important to keep in mind the old risks. I think as a risk manager that new risks are important, but don't forget the old risks. And there's a case which is related to that. The Silicon Valley crunch or collapse is related to an old risk and mismanagement of asset and liabilities, right? So mind the old risks. So a risk manager has to take into account the old risks. So taking into account that, it is really important for me, three key aspects in risk management. One, prudent and active asset and liability management. Second, a pillar for a bank, it's a fortress balance sheet. And that's something that Jimmy Dimon always says. Fortress balance sheets. And the third one, the ALCO, is mainly a risk committee. Above all. What do you think, Suresh?
I completely agree with you. When I said that new risks are keeping me up or are keeping most sleepers up at night, it does not necessarily mean that you are forsaking old risks. You're not forgetting credit risk or market risk or operational risk. You think about it. The rising interest rates in both the United States and in the UK are giving essentially rise to customer behavior disruptions in terms of early repayments or early withdrawal of deposits. These are old problems, but they are surfacing along with new problems, is all I want to point out.
Yeah, we're seeing people take on debt to pay debt. Exactly, right? Like, think about that for a minute. Yeah. And when I think about, Silicon Valley Bank, it was a culmination of things. So you had rates rising. They had a great balance sheet by buying bonds, only those bonds were short-term bonds, so when rates went up, they got killed. And on top of that, they didn't have a CRO.
CRO for nice.
So you put, how can you
but besides
as a risk manager predict that?
They didn't manage the asset and liability.
Correct, exactly.
So that is why active asset and liability management is so important.
Absolutely.
But as I said, above all, the ALCO is not a management company, it's a risk company. So
I completely agree with you. And it should not be an asset liability committee, it should be a balance sheet management committee. Most of your risks are now off balance sheet. So
okay, so SVB was not really a black swan, but it was a black swan event for a bunch of people, let's put it that way, and a bunch of risk managers who had exposure. That was a black swan event. And we've seen 2000, 2001, 2008, COVID, and now this. Tiziano, you've been in this business for a long time. You're quantitative. You measure these things. Black swan events are 1 in 100 years, and we've had how many now? How do you look at this? And is the next crisis tomorrow, or what's going on?
Well, let me introduce just a couple of examples. Well,